let's get into the market opportunities today. Don't forget, this is the ARMR Investing Way. It's how I run my own personal capital. I'm sharing with you 30 plus years of experience doing this. I try to condense it into a manageable process that gets rid of the noise and helps you just execute, protect capital when you need to, capture upside when the window's open. That's our job. Everything else is noise. Trying to guess what the market's going to do next is a joke. Trying to figure out what's in the minds of politicians is a waste of time. So all we can do is create a strategy and execute it constantly. And if we do that, our net worth is going to go up over time. We'll dramatically limit the drawdowns because we're managing our risk. And then when the window opens, boom, we put capital to work and capture it. This becomes an easier and easier process the longer you follow the ARMR Investing Way. Because what you'll discover is you'll be in cash as the market implodes. Then the market will give you a window to put money to work. And you don't have to worry about, is this window right? Is that right? What's happening over here? Here's all the bad news. How can I put money to work? None of those thoughts should be in your head when you're executing. It's very simple to me this morning and last week. We avoided a major drawdown in the market, so we've banked alpha, right? Alpha is when, if we're sitting in cash and the market drops 20% like the NASDAQ did, we have 20% alpha, right? I mean, market's cratered or whatever, right? Market's cratered, and we've captured all that alpha because we didn't lose the money. So when the window opens, a probability window opens for a tradable rally, we put money to work. We don't sit around and wonder or worry about world events. It's not about that. It's about simply executing a strategy. We've avoided a market meltdown. We have tons of alpha to spend. We're going to now try to capture some of that alpha by putting money to work when the probabilities are in our favor and the reward's worth the risk. So that's the thought process. Some of you who are new, some of you have been doing this for a while, are asking me, how do I take the ARMR Report and actually create a winning strategy? And I would submit to you that this thought needs to be at the top of your mind every day when you come in to put money to work and manage your portfolio. Are you on the right side of probabilities? Is the reward worth the risk? Have you banked alpha by being defensive as the market went down? The answer is yes to all that. Then you put capital to work. You don't worry about taking losses. There's always going to be losses that are taken when you're investing, unless you're, somebody who doesn't understand that process and then just buries their account because they don't sell anything. Okay. So I'm assuming you're an ARMR insider because you've already gotten past that part of your investing learning and you've moved on to understanding you have to protect your capital, right? That's why you're here with me. So the next difficult step, once you've figured out how to protect your capital, is when to put it back to work. Sometimes you can fall so in love with avoiding a market collapse that you don't want to put the money to work. You get locked into this belief the market's going to go down, go down to all these terrible news. But it's not about guessing. The reason we avoided a collapse, think about it this way, is not because I came to you in December and said, guys, there's going to be a ground war in Eastern Europe next year. Right? Guys, the Fed's going to be jacking up rates and reducing liquidity and the market's going to crash. I didn't say any of that. I simply said, we have algorithms here at the ARMR Report. The algorithms of the 7 big indexes are all telling us to go to cash. Those algorithms, if I were to distill for you in a simple, one line of understanding of what they do, they monitor flows of institutional capital. We like to say on our desk, information makes money. Institutions make markets. So the algos are designed to monitor institutional flows of capital. And on December 3rd last year, that monitor told us institutions are dumping equities. Then you find out later what's going on, right? The Fed in December is jacking up rates, talking about being hawkish. Then we roll into January, February. Now we got a ground war in March. So the flip side is true now. When the window opens to put capital to work, it never looks like it's a good time. And we'll find out 2 or 3 months from now. Let's pretend this is the right entry point. The ARMR algos are all telling us to put money to work. Okay? 2, 3 months from now, we'll look back and we'll say, oh, market's making all-time new highs. I'm just spitballing with you here. I'm not guaranteeing that. I'm just saying if that happens, we'll look back and say, oh, that's because there was a positive resolution in Eastern Europe, because the Fed wasn't as aggressive raising rates, whatever. You see what I'm saying? Like, you won't know that until it's already over. So we have to execute based on algorithms that give us a probability. And then we use stop losses to protect ourselves. So the information that makes us money is on the whiteboard. There, that's where we're doing research. And we put companies we want to own on the whiteboard. That's the information. Institutions make markets. The algos help us understand where those institutions are going. And then we use stop losses because none of this is 100% guaranteed. If we look at, you might wonder on the captain's note, in the captain's log, why do I share with you on some mornings what the Investor's Business Daily is saying and what Spot Gamma is saying? And I do it because I respect both of those services. I've been using William O'Neill's services since I got into the business, over 35 years ago. I'm going to say 40 years ago now, because I started investing real young. And the first thing I ever started doing was reading an Investor's Business Daily that my dad put in front of me. Okay. So I respect the O'Neill way, and I respect Spot Gamma's understanding and information about the options market. So I highlight for you in the captain's log things that I read that are important to me. So this morning, what we read in a nutshell is that Spot Gamma, while all of the gamma information is rolling higher, which is bullish ordinarily, Spot Gamma is definitely falling on the side of being negative. They believe that the rally last week was a clear-cut case of short covering based on the Fed meeting and OPEX. And what they believe, and they share with us that there was no call buying. And to them, that means there's no real, what they call vanna flow that's coming into the market, which is to say when there's a lot of calls being bought, the dealers who are selling those calls have to buy the underlying indexes, and it creates this self-fulfilling prophecy that propels the market higher. We didn't see that last week. So they view that as a negative. They say, hey, we needed to bounce off the lows. There was no call buying. Probably things are going lower. The market is now open to making new lows in 2022 is their comment. Now they'll change their tune. I respect them for this. They'll change their tune if all of a sudden call buying comes in and we get to a positive gamma environment. Hey, they'll change their tune. But for right now, they say last week is not going to lead to a tradable rally, and there's still a high level of fear and volatility. On the flip side, the Investor's Business Daily is talking about how a real tradable rally is unfolding. And it's time for us to start watching leadership stocks as they break out to see if they keep going. And then a whole new crop comes up behind it. There's a lot of quality names that showed up on their list. Let's take a quick peek at a couple of names. Okay, just a couple of chart patterns as an example. Arista Networks, right? Blowout earnings, stocks doing this, the whole market's imploding, and a big cap NASDAQ 100 name like Arista is not going lower, right? It makes a higher low above the 200-day, above the 50-day. This is a relative strength leading stock in the NASDAQ 100. We want to watch how it behaves. I'm not saying we have to own it, right? But if it skyrockets to new highs, the leadership start to follow, right? Then we go to our whiteboard, find our favorite names, and we start adding more technology names to the portfolio. So I'm going to let Arista go. I'm probably going to let Palo Alto go. I don't have to make money on Palo Alto. But if this can go make new highs on the year, right? How about AVGO? If AVGO can break out of that pennant and make new highs on the year, how about NVIDIA? Okay, if NVIDIA can, it's broken the downtrend, can it follow through? If those type of chart patterns, okay, are able to follow through in the next 5 trading sessions, and I'll explain 5 in a minute, if that happens, then a whole crop of technology names, innovator names are going to come through off of our whiteboard. And we might want to change the complexion of our portfolio a little bit by the end of the week, adding more technology, reducing a little bit of commodity. We don't know if we want to do that yet. Right now we're very balanced, okay? We're overweight commodities, okay? But we have some exposure now to some new ideas. If they start to pay these leaders, there'll be a whole crop of our favorite names coming out. And that'll mean something and we'll want to shift. So IBD is clearly saying, look, man, there's a follow-through opportunity here for a tradable rally with some leaders breaking out. So it's time to start, getting serious about putting money back to work. The ARMR report told us last week the risk monitor is green. So now let's get to how to use the ARMR report. A conservative portfolio, conservative investor is going to have some money to work when the risk monitor goes green. But don't forget that the risk monitor is a probability algorithm, not a crystal ball. Stops will be hit. It happens, right? Even a system that's right 8 out of 10 times hits the stop twice. Okay? And typically in a bear market, you'll have more than one entry point that hits a stop. That's a bear market. So what I don't do is try to predict, am I in a bear market? And am I in a bull market? I don't know, right? By the time CNBC tells you it's a bear market, the market's already dropped 20%. So who cares what the name of it is? It's like completely ridiculous and worthless information. December 3rd was the time to sell stocks. Today's the time to put some money back to work. I don't know what this market's called, and I don't care. I just execute a strategy. If I get stopped out again, all right, I get stopped out. Go back to cash market, it'll plummet again. That'll be a piece of information. If we literally get stopped out quickly, it means the market's going a lot lower. We'll flip to the short side. We'll own VIX. We'll do whatever we have to do to make money. Okay? But for right now, so let's go back over how to use the ARMR report. A conservative portfolio will have put some capital to work last week. We'll be carrying some more cash right now, and then we'll look to execute as the week progresses. Because a high percentage of the time, the new risk monitor green signals that fail in the first 5 days. So once you get past the 5-day mark, the probability is like skyrocket. Like maybe they go to like 95%. If I go back and crunch numbers and look at the data, that the market's actually going higher in the following weeks. The failures happen quick. So by the end of the week, and I thoroughly suspect somewhere in this week, there'll be a test of the stop. If that holds, reverses, and the market closes the week strong, a conservative investor will want to have all the capital to work that they want to put to work. So on the one hand, I say a conservative investor will wait to see how this week progresses before they put all their capital to work. What I do, I would say it's a more aggressive approach, but give me a minute. I want to go over that thinking for a second, because I don't consider it more aggressive, but I understand why someone would. So let's go over it. A more aggressive portfolio, which is what I run for my own personal capital and how I run ARMR portfolios, will already be 100% invested. Now, we might change, like I said, the complexion of the portfolio by the end of the week, because the bull market's really because the rally is really starting to gain steam, and I want more technology. So I might shave down commodity, add more technology. I might change the complexion, but I'm already fully invested. And the reason for that is I like to have the highest, I like to have the maximum exposure closest to the stop. I feel comfort in that. I feel safety in that. I put all my money to work as soon as I can when the risk monitor changes green. I thoroughly understand I might have a really bad day because all the stops will get hit. Okay, it's a bad day. I go back to cash. But that'll be information. If the stops are getting hit, the market's going lower. So I'll have a bad day, then the market will go lower, and I'll start building alpha again. So I don't care. To me, it's actually more dangerous to wait to the end of this week to put money to work, because now I'm further away from the stop. And if the whole thing rolls over and breaks down, I lose more money because I have to wait for it to go to the stop. This is something you'll learn over time as an ARMR investor. So I get it right now. If you don't want to put all the money to work, there's so many crazy things going on in the world. I get it. You don't have to. Wait the week out, see how it progresses, see if we start to get positive gamma, then you can put more money to work. Nothing wrong with that. But over time, executing the ARMR strategy with me over time, you'll recognize why it's actually more conservative. I know it sounds strange to put the money to work closest to the stop. Because then let's say the market pops this week. We're going to be making money already. We'll have a cushion for our principal. And if the market rolls over and implodes the following week, goes back to where we bought it, we'll be taking positions out with raised stops at break even, and our capital won't be eroded. So there's two schools of thought, two ways to put the capital to work. Either I understand, over time you'll get used to. Hey, I got to call you back. Yeah. All right. You're more important than that. All right. So let's finish this conversation up. Today, what I will be focused on the trading desk for this whole week, because risks are definitely higher this week. I put a lot of capital to work last week. Risks are higher in the first week of a new risk on green signal, and spot gamma is concerned the market's going down. Okay. So on the day trading desk, I'm going to be focusing on hedging techniques. I'm not going to be focused on getting long the S&P in a huge way. And we already have a swing trade going on the S&P. So what I've been doing for the last couple of days on the live trading desk is doubling or tripling my swing trading S&P exposure, and then booking profits. The last 2 days, Thursday and Friday, we were making money on this excessive size of S&P and then cutting it back down to the swing trading position for overnight. I'll look to do that again, setting up flip trades. So if I put an extra big position on and it hits the stop, I'll be getting short everywhere, because that'll be information that we may be in trouble. All right. I'll also look to use VIX. VIX has come off of the highs dramatically. If it sets up a bottom, I might put a VIX position on and leave it in the portfolio for the rest of the week. Hedging my portfolio, hedging my risk, if I'm forced to. Those are some of the things I'll be focused on. What I believe we have is a well-balanced portfolio right now. A lot of commodities, some innovator names, okay, a little bit of technology to see if it works. And then we'll see how the week plays out, and we'll lean in the direction we need to. Okay. Here are a couple names at the top of my whiteboard. For those of you who are day trading stocks, I am going to, as I always do, I share with you all, day trading targets and things. So the NVIDIA, the Palo Alto, the ANET, these are all things we could try to day trade, right? They had huge days. If they have weakness, pull back, hold, and give a buy signal, you could put a trade on for follow through. Okay. Tesla. No, let's take this is one of my favorite stocks to use as a lead indicator, but it also may be a great investment down here. So these all had huge runs. Let's see if there's weakness. Looks like the market's going to open a little bit weaker this morning, which is great. I hope it comes down some, finds support, reverses. We can get long Tesla, right? And then from I'm still got my eye on MP here. I'm very curious. So this might be an investment that I want to add to the portfolio. The rare earth story just keeps getting better and better. And I keep toying with this idea. So it had a huge run. We day traded it on Friday. This was the entry point Friday, and it rallied to highs, right? So it was a nice trade Friday. So let's see how this thing trades to, this morning. What we're looking for is weakness. If it comes down, tests a key level and reverses, we could put it in the portfolio and we might hold it if it rips. This is a real big cup and handle is what's going on. It's kind of like I could go like this. I'm going to leave this. I want you guys to remember what this is. A short hit piece comes out, and it only lasts for 48 hours to allow shorts to cover and longs to get long. Then the shorts realize we're really screwed, so we now to put another piece out so we can cover our shorts. So they get some rag that they pay to write a bullshit report that rehashes whatever they got another rag to write a couple months prior, because they're still caught in their short. It gaps down and they buy like crazy. And I in all humility, I told you exactly what was going on both of these occasions. Okay, so you can see it's happened twice. I don't know if there's another hit piece coming out, but if there is, we'll buy it. I mean, because it's so clear what the shorts are doing. But eventually the shorts are going to be just completely, either they're already out and then the buying really gets started as the cup and handle breaks out. This is the cup right in here, and this is the handle right here. So this could be very interesting in MP. I'm getting interested there.